What is going on, everybody? Welcome back to yet another brand new YouTube video. Now in today's YouTube video, we'll be going through the ICT silver bullet model. As always, I'll be running down through the trade itself, telling you guys the trade criteria, when to execute, when to put your stop loss, where to put your take profit, and also I'll be giving you and showing you a live trade example. So without further ado, let's get right into this video. So the first thing that I always look for before actually looking for a trade is the previous session highs and lows, which are also called the buy side and sell side liquidity levels. I'm always looking for those liquidity levels specifically in the New York session to see if we sweep one of these levels in order to look for a trade. So before even the New York 930 open, I always look onto the previous sessions, such as the Asia session and also the London session, and I'll mark up all the liquidity levels then in them. So in Asia, we have the Asia lows, and in London, we have the London lows. I do want to state something that I always want to be marking up all the liquidity levels on NQ as well as on S&P 500. Just because if ES takes a liquidity pool, such as London lows or Asia lows, and NQ doesn't, I could still look for a trade on NQ. So as we can see right here, as soon as market opens at 9:30, we see that market comes down and takes out London lows and Asia lows. These two are two forms of sell side liquidity levels. After I see that happening on the 15-minute time frame where I mark up all these liquidity levels, I jump down to the 1-minute time frame where I actually look for my entry into the trade. So these two red lines, as you can see right here, this was the London lows and this bottom line was the Asia lows. Now the principle is as soon as price sweeps a sell side liquidity level, we will be automatically looking for longs. And as soon as price sweeps a buy side liquidity level, we're going to be looking for some sort of sell side liquidity to target. So looking for shorts. So in this scenario right here, as we can see, obviously we swept a sell side liquidity levels, aka Asia lows. Now the second that we see Asia lows getting swept, automatically we're going to be looking at the trade criteria, as you can see pull up right here. So the second step on our trade criteria is going to be looking for a swing high to be created. And the reason why I'm looking for a swing high to be created is because step number 3 and step number 4 are correlated and actually directed to that swing high being created. Without that swing high, we could actually not go on to having and taking a trade that is valid. So as you can see right here, we do get this swing high created at 9:45, and also we're always going to make sure that both assets are correlating, meaning if NQ gives a swing high, I also want to see a swing high on the S&P 500. And the reason being is because when both assets are correlating, meaning they're doing the same thing and showing the same price action, indicates to me that there is a lower chance of manipulation. So if we look very closely to the right, we also get the swing high that is created at 10:45 on the S&P 500. So far, so good. Now comes step number 3 and step number 4. And these two steps are pretty much in one candle. And I'll show you guys what I mean by that right now. So step number 3, we have a market structure shift. And step number 4 is a displacement. So let's just focus on the market structure shift first. And if you look very closely, this 1049 candle right here breaks and closes above this swing high that we marked up at 1045. So that is just called a market structure shift, that break and close above this swing high. And the displacement is within that market structure shift. It's a big, strong move and push to the upside. Indicates to me that price is willing to seek higher prices and key levels. Now, again, back to the correlating assets thing, we always have to have and make sure that we get the exact same market structure shift and displacement on S&P 500. Again, to explain the market structure shift, this candle at 1048 opens and closes above this 1045 swing high. That is a market structure shift. And as you can see, this big strong push to the upside is a displacement. Now coming into checkpoint number 5 on our checklist criteria, it's going to be a fair value gap. Now it's very important to see a fair value gap form, as a retracement into that fair value gap is actually going to be our entry going long. So if we zoom very closely, we actually do get a very, very small fair value gap, but it is still a fair value gap. No matter how big or small the fair value gap is, it is still a fair value gap. Now this fair value gap is only a quarter of a handle, and if we draw that out in time, we see it right there. And if we look to the right hand side here on S&P 500, we do get a much larger fair value gap. Now something that I do want to mention to you guys is that we don't always have to have a fair value gap form on ES in order to have a trade on NQ. We must though get a fair value gap on NQ, or else we do not have a trade. We need to have step number 2, step number 3, and step number 4 all correlating. So both assets need to be doing these steps, number 2, number 3, and number 4. Other than that, we could have a trade that is valid. Now, the retracement into the fair value gap is when we're going to be entering long. And a retracement is pretty much price coming and visiting this fair value gap again. And as you can see, price comes and retraces into this fair value gap, taps into it at 10.50. That's exactly when we are going to execute. We put a limit order, so as soon as price taps into that fair value gap, we enter the trade long. Now for our stop loss, we always want to place our stop loss below the nearest swing low to the left of us, and in this scenario right here, it's going to be that 10.48 swing low, so our stop loss goes below there. So now for our targets, what are we going to be targeting for our take profits? Now, if you can see right here, we do have a big range to the downside. And what I mean by that is price is pretty much going to the downside in a smooth manner. So having seen that, I always want to actually mark up all this range and see the 50% of this range. The upside is called a premium and the lower side is called a discount. Price moves from discount to premium and from premium to discount. So having said that, I know that price is most likely going to head up and tap into the premium, but I do not want to take my full profits at that 50% of the range. I want to take partials just to secure some profits on the day, and you guys do the same also. So if we look very closely, we have multiple take profit points right here. The first one could be this swing high right there, as that is a very, very low hanging fruit. Now, the second take profit that I'm going to be looking for is obviously this swing high right here as a minor buy side liquidity level. And obviously the third I'm going to take is this 50% of the range. Now, if you do want to leave a runner or two, you could definitely leave a runner to this swing high right here, which is again a minor buy side liquidity level. And as we can see, price does actually not go hit that, but that is absolutely fine because by now you would obviously have your stop loss to break even. So here are the targets that you will be targeting. Now let's talk a little bit about the stop loss placement. Now you might be wondering, why did I not put my stop loss all the way to this swing low, or maybe below this candle's low? Well, the reason being is because if you look very closely, if price is going to be going in an uptrend, it's going to be making higher highs and higher lows. As you can see right here, this low does not get hit. This low does not get hit, and so on and so forth. All these lows do not get hit. They make higher lows. So having said that, as soon as I execute the trade, I look to the nearest swing low to the left of me, which is going to be this one right here, and I'm going to be placing my stop loss there, because if price is going to actually go to the upside and keep on trending to the upside, then there is no point for price to come in and sweep this swing low and then go to the upside and trend to the upside. So that is actually how we know where to put our stop loss, rather than just putting it anywhere or anywhere we feel like. Now, coming into managing your risk in this trade, and I don't mean money wise or contract wise, I mean how much you're going to be reducing your risk and actually having a risk-free trade after what happens. So if you can see right here, we do get this swing high right here that is created after we're inside of the trade now. Again, that gets broken and closed above. After I see that, I'm going to again take my stop loss and I'm going to reduce risk and put it to the nearest swing low to the left of us, which is right here. Again, after a while, we'll see the swing high and we break this swing high right here with this candle at 10.57. And at this point, we usually want to put and place our stop loss at break even. Therefore, if price decides to reverse, we are stopped out for break even. And if you look very closely, after a while, we do get a swing high that is created at 11 o'clock and we break and close it at 11:09. Then we want to look for the nearest swing low to the left of us, which is this one right here. Now, I would definitely put my stop loss below this swing low right here. As I mentioned earlier, if price is going to trend up and actually go hit our targets, then there's no need for price to come and take this swing low out in order to pull up higher and higher. Now, something that I do want to mention to you guys is the macro times. Now, this is a very, very crucial point and topic. These macro times are two 30-minute intervals in the New York AM session. The first AM macro from 9:45 all the way to 10:15, and the second AM macro from 10:45 all the way to 11:15. Now, these two 30-minute intervals are extremely crucial to execute in, and do not try to execute outside of these two macro times. And the reason being is price usually tends to make a run to key levels during these two 30-minute intervals rather than outside these intervals. So make sure to always execute within them and not outside of them. Now, you can have obviously a trade run outside of these times. You don't have to close your position out as soon as these two intervals close or outside of these two 30-minute intervals. But as long as you execute in them, you are absolutely fine. And there you guys have it, the ICT silver bullet model right in front of you guys. Now, if you do have any questions, let me know in the comments down below and I'll be sure to get to them within the next 24 hours or less. And also, guys, do me a massive favor, hit that subscribe button. We are about on our way to 1,000 subscribers. So hit that subscribe button. Now, I do offer a VIP top trading floor Discord server where you guys could come in and literally take bangers like this with me on a regular basis and bag around 123 handles on the day, which is absolutely insane. So if you guys are interested, the link will be in the description down below. On top of that, I also do offer a premium Discord community, such as having the blueprint of my full strategy, a full psychology page where you guys could help in your psychology, and a VIP top traders floor chat where you guys could come in and literally chat with like-minded traders like yourself. Now, if you guys are interested, the link will be in the description down below. Thank you guys for watching. I love and appreciate each and every one of you guys. And until the next time, peace.